Welcome back to the Deep Dive. Today we're taking a stack of research, analyst reports, SEC filings, the whole 9 yards,
Yeah.
to give you that shortcut to being really informed.
Yeah.
And the company we're tackling is one that's absolutely vital to, well, the next phase of global tech, but honestly, most people haven't heard of them. Fabrinet, ticker FN.
That's right. And this is a deep dive into what you might call the hidden plumbing of the whole AI revolution. That's fascinating, really.
Hidden plumbing, I like that.
Because Fabrinet, they aren't just, churning out components like a standard manufacturer. They're this highly specialized precision engineering partner. They enable the really demanding tech, especially in high-speed optics.
So the stuff that makes data centers talk at light speed.
Pretty much. We're talking terabit speeds. They build the critical pieces for that.
Okay, so our mission today is pretty laser-focused. We need to unpack these sources, figure out exactly what Fabrinet makes these specialized products, why they're so critical for this huge AI and cloud build-out that's happening everywhere.
Right.
And this is key, how their financial model, their specialized approach, lets them kind of stand head and shoulders above the usual low-margin manufacturing crowd.
And there's one sort of central question driving this whole thing, isn't there?
Yeah, lay it on us.
How did this company, a contract manufacturer, mostly based out in Thailand, manage to become one of the most direct ways to invest in the AI infrastructure boom?
Right. How did that happen?
Well, the answer, I think we'll find, is rooted in decades of cultivating this really unique mix of engineering skill and, just as importantly, operational trust.
Okay, let's dig into that core business model then. The sources, they keep hammering this point. Fabrinet isn't your standard EMS, electronics manufacturing services company. They've deliberately carved out a different space. What makes their approach so specialized?
Well, they focus exclusively on, let's say, advanced manufacturing services, right? But only for OEMs, the original equipment manufacturers. Yeah. And crucially, only for products that are highly complex and mission critical. So we're not talking about, assembling millions of cheap consumer gadgets.
No smartphones here.
Definitely not. Think optical components, electromechanical devices, high-end electronics, stuff that needs micron-level precision, hermetic sealing, things where, an error the width of a human hair makes the whole thing useless.
Wow. So, okay, if a typical EMS player is all about volume, making millions of identical low-margin parts for, say, phones,
right?
Fabrinet is optimizing for something else entirely. Complexity, fidelity. They use this phrase, low volume, high mix. How does that define them?
It's a totally different way of thinking. The standard EMS model, it's usually capital intensive, sure, but the labor can be simpler. It's about maximizing output, minimizing cost on parts that are often commodities.
Get it cheaper, make more.
Exactly. Fabrinet's low volume, high mix approach, that's engineering intensive, it's precision focused. Their whole goal is doing incredibly complex things perfectly, sometimes for just a few thousand units a year for a specific product line.
That sounds like it requires a very different kind of workforce.
It does. Highly skilled labor, proprietary equipment they often develop themselves, and just obsessive, meticulous process control. It's a different culture.
And that technical focus, that DNA, seems like it goes right back to the very beginning, doesn't it? The founding.
It absolutely does. The company was founded back in 2000 by David T. Mitchell. And he wasn't just anyone. He was a co-founder of Seagate Technology.
Seagate, the hard drive company. That feels like a jump. Hard drives to optical networking.
On the surface, maybe. But think about the core requirement for hard drives back then, especially in the early days.
Okay.
Extreme precision. Aligning that magnetic read-write head over a platter spinning insanely fast. That needs process control, cleanliness levels. It's incredibly demanding engineering.
Right. Okay. I see the link now. Precision.
Exactly. Mitchell took that deep, ingrained expertise in managing microscopic tolerances, working in clean room environments, and applied it directly to optical manufacturing. Aligning tiny optical fibers, bonding lasers. These are notoriously difficult technical challenges.
So he basically transplanted that precision culture.
Pretty much. And that gave them a defensible niche, a high barrier to entry right from day one.
And this focus, this technical partnership, it seems to run through everything they offer. It's not just, here, build this, They're involved across the whole life cycle.
That's how they position themselves, yeah. A comprehensive end-to-end partner. They'll help with process design, sourcing critical, hard-to-find components, doing the advanced optical packaging, the manufacturing itself, final assembly, all the testing procedures.
So the whole package.
But here's where they really differentiate themselves and grab a bigger piece of the value. It's their vertical integration strategy.
Meaning they make some of the internal components themselves, not just source everything.
Yeah.
Why is that so important in optics?
Because they make the really hard parts in-house. Fabrinet actually has the capability to design and fabricate certain application-specific components. We're talking custom crystals, precision prisms, specialized mirrors, complex glass assemblies.
Stuff you can't just buy off the shelf easily.
Exactly. And this isn't trivial. When you're building, say, a high-speed optical transceiver, you run into this problem called tolerance stack-up.
Ah, right. Where tiny imperfections in lots of different parts add up to one big problem in the final product.
Precisely. If Fabrinet just bought a mirror or a crystal from supplier X, they'd inherit whatever tolerance limits that supplier works to.
Which might not be good enough.
Might not be. By designing and making these critical bits themselves, they can control everything, the material properties, the surface finish, the exact geometry, to make absolutely sure the final assembled product meets these incredibly tight, near-zero defect standards you need for mission-critical stuff.
So they control the quality from the inside out.
Right. That vertical control lets them manage things like thermal expansion and optical alignment across the entire assembly. They can guarantee performance and reliability in a way that just cobbling together third-party parts often can't.
Okay, that level of deep integration, getting access to proprietary designs, especially when you're dealing with behemoths like NVIDIA, Cisco, and now apparently AWS, it brings up the IP question immediately. Intellectual property. If Fabrinet is making the secret sauce, how do these giant tech companies trust them not to, let secrets slip?
This might be their single biggest competitive advantage, their operational moat, if you like. It's what they call the factory within a factory model.
Factory within a factory.
Yeah. They fundamentally understand that in this business, trust is everything. It's the currency. So to earn and keep that trust, they physically segregate operations for key customers.
You mean like walls, actual walls?
Literally.
Yeah.
Dedicated manufacturing space, separate equipment, distinct supply chain logistics, even dedicated teams of employees who only work on that one customer's products.
So inside one Fabrinet building, NVIDIA's line is completely walled off and separate from Cisco's line.
That's the idea. It's a secure, self-contained ecosystem for each major partner within the larger campus. This setup prevents any accidental or intentional cross-contamination of proprietary processes, sensitive production data, unique technology designs, anything.
That sounds incredibly complex to manage.
It is, but they also back it up with technology. Customized software platforms that give customers secure, real-time remote access to monitor their own production lines, things like yield rates, inventory levels, component quality data from suppliers.
Wow, so deep transparency too.
Exactly. That combination of physical segregation and operational transparency, that intense focus on IP security, it's non-negotiable for these customers. It's the absolute foundation for these long-term partnerships. Without that level of trust, they simply wouldn't win the contracts for the most advanced, most critical components, period.
Okay, so the foundation is clear. High-precision manufacturing, vertically integrated, built on this bedrock of trust. Now, let's follow the money. This is where we really connect Fabrinet's work to this AI infrastructure explosion we keep hearing about.
Right, and the sources are really clear on this. Fabrinet's revenue, it's overwhelmingly driven by optical communications. For their fiscal year that ended June 27, 2025, that segment brought in a whopping 76.6% of total revenue.
Almost 80%, wow.
Yeah, the rest, non-optical communications, which is important too, made up the remaining 23.4%. We can talk about that in a sec.
Let's stick with that optical engine for a minute.
Yeah.
That 76.6%, it splits into telecom and datacom, right?
Yeah.
And it sounds like datacom is where the AI action is really heating things up.
Absolutely. So in the last reported quarter, Q4 of fiscal 25, total optical revenue was $689 million. Now, telecom that's more focused on the big carrier networks, the long-haul stuff,
Okay.
that relies heavily on products like optical amplifiers and these things called ROADMs. That part brought in $412 million.
Hold on, ROADMs. That sounds complex. What exactly is a ROADM, and why is it a high-value part for Fabrinet to make?
Good question. ROADM stands for Reconfigurable Optical Add-Drop Multiplexer. It's a pretty sophisticated piece of kit.
This sounds like it.
What it lets network operators do is manage data streams, change their paths, add new signals, drop others off, all within the optical layer, without ever having to convert the light signals back into slower electrical signals first.
Ah, so it keeps everything moving at light speed, basically.
Yeah.
More efficient.
Massively more efficient. Vital for squeezing the most bandwidth out of long-distance fiber. And building them requires incredibly precise alignment of components, complex sealing. It's right in Fabrinet's wheelhouse. High value, high complexity.
Got it. Okay, so that's telecom. Now back to datacom, the AI piece.
Right. Datacom. This is the segment directly tied to the hyperscale data centers, the cloud providers, the AI clusters. This part contributed $277 million in Q4 FY25, and it's growing fast. Because this is where Fabrinet builds the absolute highest speed components needed inside the data center for server-to-server communication. High-speed transceivers, tunable transponders, all the fiber optic interconnects that stitch these massive compute clusters together.
And as AI models get bigger and more complex,
The need for faster and faster connections within the data center just explodes. So, yeah, the datacom segment is really the engine driving that high-margin growth right now.
makes sense.
Oh.
Okay, so optical is clearly the giant here, but that non-optical segment, the other 23.4%, it does provide some diversification. What are the key parts of that business?
Yeah, it's definitely important for balance. That segment generated $221 million in Q4 FY25. And the really interesting growth driver within non-optical is automotive. That subsegment pulled in $128 million.
Automotive. We're not talking about, like, standard car radios, are we?
No. Again, think high complexity. Fabrinet is making advanced sensing and lighting components for modern vehicles. Things like LiDAR system.
The laser-based distance sensing for self-driving tech.
Exactly. Plus advanced LED and laser lighting systems, complex safety sensors. It's another area needing precision manufacturing. It gives them these high-value, pretty durable revenue streams tied into that whole trend towards smarter, safer, potentially autonomous vehicles.
Interesting. What else is in non-optical?
There's also industrial lasers. That holds pretty steady, around $40 million a quarter. These are lasers used in high-precision manufacturing processes themselves, cutting, welding, marking. And then there are smaller bits in things like medical diagnostics and life sciences equipment.
Okay, so strong optical core, growing non-optical diversification. But now we have to hit the big vulnerability. Working with giants is great, until it isn't. This customer concentration risk.
The sources seem pretty worried about it.
They are, and rightly so. It's flagged as the #1 financial risk factor. For the full fiscal year 2025, their top 10 customers accounted for 86% of all revenue.
86% from just 10 companies? That's high.
It is, but zoom in further, and it gets even more stark.
Let me guess. NVIDIA.
NVIDIA was #1,
Mm.
28% of total revenue in FY 2025. Wow. More than a quarter from one customer? Who's number 2?
Cisco at 18%.
Okay, so just those two, NVIDIA and Cisco. That's 28 plus 18. 46% of their entire business from just 2 customers.
46%, yes.
Oof, that feels incredibly risky. How do you even justify that? I mean, even if the AI market is booming, isn't that just trading one kind of risk-broad manufacturing for another, maybe even scarier kind, relying on the whims of 2 giants?
It's absolutely a major risk, no question. The justification or maybe the mitigation investors focus on is the nature of those relationships. These aren't simple contracts for commodity parts that can be easily swapped out.
Because of the complexity and IP we talked about.
Exactly. Fabrinet is building mission-critical, IP-sensitive, super complex components. The cost and hassle for NVIDIA or Cisco to switch manufacturing to someone else would be enormous. They'd have to requalify everything, risk production delays.
So the switching costs are sky high.
Astronomically high. These partners tend to view Fabrinet almost as an extension of their own R&D and manufacturing, a strategic asset. So the risk is there, but it's somewhat offset by how deeply embedded Fabrinet is, how sticky these contracts are, especially for the most advanced products. But eliminated? No, definitely not.
Still feels like walking a tightrope.
Yeah.
Now, speaking of customers, they did just announce a big new one. Looks like diversification, maybe.
Yes. That's the big recent news. A major new partnership with Amazon Web Services, AWS. Management is saying they expect this to be a meaningful revenue contributor starting in fiscal 2026.
Okay, AWS. That's huge. Adding another big name, less reliance on just NVIDIA and Cisco. Sounds positive for diversification, right?
Well, yes and no. It is diversifying the customer list, which is good on the surface, but you have to look deeper.
Okay.
Adding AWS actually deepens their underlying concentration in the end market. AWS is one of the biggest builders of cloud and AI infrastructure on the planet.
Ah, so now they're even more tied to hyperscale spending.
Precisely. Fabrinet is becoming more intensely focused than ever on the capital spending cycles of this very small group of tech titans, NVIDIA, Cisco, now AWS, who are all driving this massive global AI and cloud build-out. So the risk profile changes slightly. It's less about what if Cisco stumbles and more about what if overall AI CapEx slows down.
If that tide goes out, they're really exposed.
They'd feel it immediately, yes.
Okay. And this massive demand, particularly from the AI side, it's also forcing a technology shift, right? Faster components, which plays right into Fabrinet's strengths.
That's the engine behind the current surge, exactly. The market is moving really aggressively right now, away from the older 400 gigabit or 400G components, even past 800G and ramping up the next generation. 1.6 terabit transceivers, 1.6T.
Terabits, that's a fast.
Insanely fast. And Fabrinet started shipping these 1.6T components in volume in Q4 of fiscal 25. That ramp up was the main reason their datacom business jumped 10% just in that one quarter.
So higher speed equals more complexity equals more value for Fabrinet.
That's the dynamic. In that same quarter, Q4 FY25, their revenue from the really fast stuff 800G and the new 1.6T combined grew 32% sequentially, quarter over quarter.
32% growth in the fastest components. Why such a jump?
Because making a 1.6T transceiver is just way harder than making a 400G one. It needs much more specialized optical packaging, micro laser bonding techniques, way more precision in aligning everything. These are high-value, super complex parts that play directly to Fabrinet's unique skills. So this tech transition forces customers up the value chain right into Fabrinet's sweet spot. They aren't stuck making yesterday's commoditized parts.
And it looks like Fabrinet is leaning into this AI angle very deliberately in how they even talk about their business now. There's a reporting change.
Yes, and it's a really clear signal to the market, to investors. Starting in the first quarter of fiscal 2026, so the quarter they're likely in as we record this, Fabrinet is strategically changing how they report things.
How so?
They're getting rid of some of the older, more technical breakouts, things like specifically reporting silicon photonics revenue or revenue by data rate, like 400G versus 800G.
Right.
And instead, they're introducing a brand new, separately reported segment called High Performance Computing, or HPC.
HPC. Why is renaming or reclassifying things like this so significant?
It's all about aligning the narrative. It's management speaking directly to where the investor money and excitement is. HPC, in this context, is basically code for AI infrastructure.
Right. The massive computing power needed for training large language models, complex simulations, machine learning.
Exactly that. By creating an HPC segment, they're shifting the focus away from how they build the stuff, the technical manufacturing details, and toward what the stuff enables. This premium, highest growth AI market driven by their biggest customers. It's a strategic move to make sure Wall Street values them as a key AI enabler, not just another contract manufacturer.
Well, let's zoom out a bit and put Fabrinet's success in context. This market they play in. Photonics, fiber optics, it's huge, right?
Oh, it's absolutely gargantuan. The overall global photonics market, basically the industry dealing with light science and its applications, was estimated at, what, $921 billion in 2023?
Billion with a B.
Yep. And forecasts suggest it could nearly double, hitting something like $1.64 trillion by 2032. That's a solid, 6.7% compound annual growth rate.
Okay, massive market. What about their specific niche, the fiber optic components?
That's also growing really nicely. Projections show that piece going from around $37 billion today to maybe $59 billion by 2030. That's closer to a 10% CAGR. 9.8%, I think, was the number. So yeah, they are definitely operating in a rapidly expanding pond.
With growth like that, you'd expect fierce competition. How does Fabrinet keep its edge, especially against some of the big component companies that do everything, from design to sales?
This goes back to something we touched on earlier. Their single biggest competitive advantage might just be their conflict-free status. You really have to contrast them with some of the major vertically integrated players out there, companies like Lumentum or Coherent.
Okay, what's the difference?
Lumentum and Coherent, they design, they manufacture, and they sell their own branded end products. Like, they'll sell a finished optical transceiver module directly to a cloud provider or a network equipment maker under their own name.
Which means they're potentially competing head-to-head with the very OEMs that Fabrinet serves, like Cisco or others.
Exactly. If you're Cisco and you hire Lumentum to manufacture some components for you, you're essentially handing over sensitive designs and process details to a company that might be trying to sell a competing product against you in the market.
Creates an awkward situation, potentially.
Very awkward. Fabrinet, on the other hand, is a pure-play manufacturer. They don't design their own end products for sale. They don't have their own brand competing in the market.
So they have no hidden agenda.
Right. They eliminate that potential conflict entirely. This builds incredible trust. Their OEM customers know Fabrinet's only goal is to make them successful, not to eventually undercut or replace them. That alignment is a massive strategic edge, especially when you're dealing with next-generation, highly sensitive IP.
Makes sense. Beyond that trust factor, though, there must be other big hurdles stopping new companies from just copying the Fabrinet model, especially now that the AI opportunity is so obvious. What are the main barriers to entry?
Oh, the barriers are significant, multi-layered, and very expensive to overcome. First off, there's the specialized technical know-how.
The precision stuff we talked about.
Yeah, and this isn't something you just pick up from a manual or a university course. We're talking about tacit knowledge, skills built up over decades, the kind of art required for aligning optical fibers perfectly under intense magnification, the complex materials science needed for things like hermetic sealing to ensure reliability over years.
So you can't just hire a bunch of engineers and start tomorrow.
Not even close. It's a deep bench of expertise you have to build over time. Secondly, there's the sheer capital cost.
Building the factories.
Building and equipping a factory capable of doing this kind of advanced photonics manufacturing is prohibitively expensive. The sources suggest a single state-of-the-art facility can run anywhere from $100 million to maybe even $500 million.
$500 million for one plant. Wow.
Yeah, and that's before you even factor in the years it takes for site prep, getting all the permits, regulatory approvals. It's a huge long-term investment.
Okay, expertise, capital. But maybe the biggest wall in this kind of complex space is getting customers to actually switching costs.
They are enormous. And it's not just about money, it's about time and risk. Before an OEM like NVIDIA or Cisco would even consider moving a critical complex production line to a new unproven manufacturer, they require incredibly lengthy and expensive qualification periods, often 18 months, maybe even up to 36 months. 2 or 3 years.
Like to prove the new supplier can do it reliably?
Exactly. They need to validate the entire process, ensure the yield rates are stable, prove long-term reliability. No OEM is going to risk messing up their own product launches or delivery schedules by switching manufacturers lightly, especially not for the components going into their fastest-growing, highest-margin products.
So once you're in, you're likely to stay in.
That reluctance to switch translates directly into very sticky long-term partnerships for Fabrinet. It's a huge defensive moat.
Okay, let's pivot to where this all happens. We mentioned Thailand earlier. This whole massive, precise operation is pretty geographically concentrated, isn't it? What's the strength and the obvious risk of that footprint?
Right. So legally, Fabrinet is incorporated in the Cayman Islands, likely for tax and legal structure reasons, but operationally, the entire engine runs out of Thailand. They have 2 very large, strategically positioned campuses near Bangkok, one called Pinehurst, the other Chonburi.
Why Thailand? What's the advantage there?
The key factors seem to be access to a highly skilled technical labor force that's built up expertise in this area, combined with a significantly lower overall operating cost structure compared to running similar facilities in, say, North America or Western Europe.
So skilled labor plus cost savings.
And having everything concentrated geographically provides huge operational efficiencies. They can scale processes, move resources between the campuses relatively easily, integrate complex workflows across adjacent facilities.
But putting all your operational eggs in one geographic basket. That comes with some pretty obvious risks, doesn't it? The sources mention this.
It's the classic trade-off, isn't it? That reliance on one primary region absolutely exposes them to potential large-scale disruptions. And their own SEC filings explicitly call out these risks. Things like regional political instability, unexpected changes in government policy or regulations, and significantly natural disasters.
Like the flooding they had a number of years ago.
Exactly. They experienced severe flooding that significantly impacted their operations and supply chain back then. Now, they've invested heavily in flood mitigation and other business continuity measures since that time, but the fundamental risk of a major centralized disruption, whether it's political, environmental, whatever, it remains a critical factor for anyone looking at the company.
And despite that risk, Management is doubling down right now, pouring huge amounts of money into expanding capacity right there in Thailand.
They are betting big on that location and on continued demand. They're deep into constructing this massive new facility known as Building 10 at the Chonburi campus. The estimated price tag is around $132.5 million.
Building 10. That sounds significant.
It is, and the demand, particularly from the AI sector, is apparently so intense that management has said they're even looking at ways to accelerate the completion timeline for parts of Building 10. They want to hit their stated goal of reaching $1 billion in quarterly revenue, and they need that capacity online ASAP to do it. It's probably the clearest sign of their confidence, both in their Thai operations and in the longevity of this AI demand cycle.
All right, let's shift to the financials. This AI wave, this demand, is clearly translating into some impressive numbers for Fabrinet.
Right.
What did the fiscal year 2025 results look like?
Yeah, the growth trajectory is pretty striking. For the full fiscal year 2025, revenue hit $3.42 billion. That's a solid 19% increase year over year.
19% top-line growth. Pretty strong. What about profitability?
Even better, arguably. Their non-GAAP diluted earnings per share, or EPS, came in at $10.17. That's up quite a bit from $8.88 in the prior fiscal year. So they're showing strong growth, not just in sales, but also in efficiency and profitability.
Now, margins. For a contract manufacturer, margins are usually the tough part, often razor thin. You mentioned Fabrinet stands out here. How good are their margins and why are they sustainable?
This really is a key differentiator. They managed to maintain a pretty strong and importantly stable gross margin. On a GAAP basis, it consistently runs around 12%.
12% gross margin? Just for context, what would a more typical generic EMS provider see?
Oh, much lower, often mid-single digits, maybe 4%, 5%, 6% gross margin if they're doing well on a high-volume, lower-complexity product.
So Fabrinet is getting double or even triple the gross margin. How?
It's the direct payoff from their specialized niche strategy. That 12% gross margin comes from a few places. One, their scarcity value. There just aren't that many manufacturers in the world qualified to build these super complex 1.6T optical components at scale.
Okay, limited supply of capability.
Two, it's the value capture from that vertical integration we discussed. They make margin on those difficult-to-produce crystals and prisms they fabricate in-house, not just on the assembly.
Yeah.
And three, there's arguably a security and trust premium. Customers are willing to pay a bit more for that conflict-free status and the guaranteed IP protection that comes with the factory within a factory model. They aren't just competing on the cost of assembly labor, they're competing on unique engineering knowledge built over decades.
And that translates down the income statement too, right? Operating margin.
Yes. They achieved a record non-GAAP operating margin of 10.7% in Q4 of fiscal 25. That's incredibly strong for any kind of manufacturing-centric business.
Okay, strong growth, strong margins.
Yeah.
Now, the balance sheet. Our sources use the term fortress. That sounds unusual for a company growing this fast and investing heavily in new factories.
Fortress is absolutely the right word, and it gives them a huge competitive advantage. As of the end of their fiscal year 2025, Fabrinet was sitting on a mountain of cash and short-term investments over $934 million.
Nearly $1 billion in cash.
And here's the real kicker. Zero total debt. None.
Wow. Zero debt and almost $1 billion in cash while they're building $100 million factories. That sounds almost too conservative.
Is that financial prudence, or could it be strategic timidity? I mean, in a high-growth market like this, isn't holding nearly $1 billion with no leverage potentially inefficient? Could they be missing chances to grow even faster or make a big acquisition by not using that balance sheet more aggressively?
That's the core strategic debate, isn't it? And it definitely reflects a very conservative management philosophy. They've clearly prioritized financial flexibility and self-funding over optimizing the balance sheet through leverage.
What's the upside of that approach? The upside is resilience and control. They can fund massive projects like Building 10 entirely from their own cash flow and reserves. They aren't exposed to rising interest rates or dependent on the whims of the capital markets. Their liquidity ratios are fantastic. Current ratio of 3.0, quick ratio over 2.0, meaning they have tons of liquid assets relative to short-term liabilities. Management seems to view that cash hoard as strategic dry powder, ready to deploy if the perfect organic growth need or maybe the right acquisition comes along, but they avoid the execution risk that can come with rapid debt-fueled expansion.
Okay, so flexibility and risk mitigation over leverage. Now, speaking of funding, Building 10, let's talk about cash flow. That big investment cycle must be impacting things right now.
It is temporarily. Fabrinet is usually a very strong cash generator, but in that last reported quarter, Q4 FY25, their operating cash flow was about $55 million. However, their capital expenditures, or CapEx, were almost as high, $50 million.
So free cash flow operating cash minus CapEx was almost nothing for that quarter.
Pretty much flat, yeah. But here's the critical context. That $50 million in CapEx was almost entirely growth CapEx. It was money spent on buying new equipment needed for 1.6T production and the physical construction of Building 10. It wasn't just maintenance spending.
So it's an investment phase, a temporary dip in free cash flow.
Exactly. Management has guided pretty clearly that they expect CapEx to start normalizing, meaning falling back towards lower, more typical long-term levels, probably in the second half of fiscal 2026, as these big expansion projects wrap up.
And when that happens?
When that happens, the gap between their strong operating cash flow and the now lower CapEx number should widen significantly. That means you should see a pretty dramatic reacceleration in their free cash flow generation. That $934 million cash pile could start growing much faster again.
So when that cash starts piling up even more, what does management plan to do with it? What's their capital allocation philosophy?
It seems to be a very clear two-step approach. Priority number one always is reinvesting in organic growth.
Building 10.
Exactly. Funding the facility expansions, buying the advanced equipment, hiring the engineers, whatever is needed to capture the immediate market demand. That comes first.
Makes sense. And priority number 2, returning cash to shareholders.
Yes, but exclusively through share repurchases. Fabrinet does not pay a dividend.
Why no dividend?
It typically signals that management believes they can generate better returns for shareholders by reinvesting capital back into the business's growth, or by buying back stock, which reduces the share count and boosts earnings per share, rather than just sending cash out as dividends. They were pretty active on this front in fiscal 2025, buying back about $125.7 million worth of their own shares.
So growth first, buyback second.
Yeah.
Got it. And just quickly, the team leading all this, experienced.
Very experienced, particularly in specific industry. The CEO, Seamus Grady, and the CFO, Saba Swearha, are both veterans. They actually spent over a decade each in senior roles at Sanmina.
Sanmina, one of their main competitors.
Yeah. Exactly. So that shared background means they have deep, proven expertise in managing exactly this kind of complex, large-scale, global contract manufacturing operation. And importantly, they've built a strong track record recently of meeting or beating their financial guidance, which builds a lot of credibility, especially when you're asking investors to trust you through a period of rapid growth and heavy investment.
Okay, we've covered the specialized business, the AI connection, the financial strength, but every deep dive needs a skeptical look at the downsides. Let's hammer home those concentration risks again. They seem critical.
They absolutely are, and they really can't be emphasized enough. That dependency on NVIDIA, Cisco, and looking forward, AWS, it's the single biggest vulnerability. Because if any one of those giants suddenly loses significant market share in their own business or decides to shift their manufacturing strategy, maybe bring more production in-house, or give a bigger slice to a competitor of Fabrinet, the impact on Fabrinet's revenue and profit would be immediate and severe. It means Fabrinet's fortunes are fundamentally lashed to the health and the capital spending cycles of just a tiny handful of massive tech companies.
One sneeze from NVIDIA could give Fabrinet a cold.
A pretty bad one, yeah. And then there's the geographic risk. Still all about Thailand.
Correct. Operationally efficient, yes. But the entire manufacturing base remains vulnerable to things specific to that region. Political shifts, regulatory changes, or, as we discussed, a major natural disaster. They've invested in mitigation, sure, but you can't completely eliminate the risk of having all your critical production in one primary location.
Okay, those are the big structural risks. What about nearer-term challenges? The execution headwinds they face just navigating this period of super fast growth. Yeah, these are sometimes called high-class problems. Problems you get because you're growing so fast, but they're still real challenges. The first one is component supply constraints.
Bottlenecks.
Exactly. The speed of this shift to 1.6T components has, at times, outstripped the ability of the wider supply chain to produce certain critical inputs fast enough. Things like specialized laser diodes or particular high-end chipsets needed for these transceivers.
So even Fabrinet can't build faster if they can't get the parts.
Right. And management has been upfront about this. They specifically guided that these supply constraints were expected to cause a temporary dip, a sequential decline, in their datacom revenue in the first quarter of fiscal 26. It's a problem driven by too much demand, ultimately, but it highlights that even Fabrinet isn't immune to friction in the global supply chain.
Okay, supply constraints. What's the second execution headwind?
Margin pressure from ramping up big new programs.
Ah, the learning curve effect.
Exactly. When Fabrinet lands a huge new piece of business, like the massive AWS contract, or when they start building the very first products for that new HPC segment, those programs typically start out at lower gross margins than their mature products.
Why is that?
It just takes time. Time to fully optimize the new production lines, work out all the kinks in the process, train the staff, get the manufacturing yield rates up to target levels. It's a standard learning curve. So while these huge new programs are great for long-term growth, they will likely put some temporary downward pressure on those record high operating margins that they just hit. The expectation is margins recover and even exceed prior levels once the programs reach full scale, but there can be a dip initially.
Got it. So concentration risks, execution risks. Yet, despite all that, Fabrinet's stock trades at a really high valuation compared to other manufacturers. Why does the market give them such a premium multiple?
The valuation is probably the clearest sign that the market doesn't see them as just another manufacturer. Their forward price to earnings, or PE ratio, is currently sitting around 29.6 times earnings.
29.6x. How does that compare to peers?
It's way higher. If you look at more traditional, broad-based EMS companies like Jabil, maybe Sanmina, where the execs came from their forward PE ratios are significantly lower, more in the, say, 17x to 20x range.
So the market is paying almost 50% to 70% more for each dollar of Fabrinet's expected earnings.
Roughly, yeah. It's a clear divergence.
So the market is basically saying, you're not an EMS company, you're a technology enabler.
Precisely. Fabrinet is being valued as a scarce, specialized provider of critical technology with direct, high-leverage exposure to the AI infrastructure build-out. That premium valuation reflects belief in their unique, conflict-free moat, their superior and more stable margin profile, and the fact they offer investors such a direct play on AI and hyperscale cloud spending.
But that high valuation comes with high expectations, right?
Absolutely. A 29.6x forward PE demands near-flawless execution. It demands they maintain those strong margins even as they ramp new business. And fundamentally, it embeds a strong belief from the market that this current AI-driven demand cycle is not just a short-term blip, but a durable, multi-year secular growth trend. Any sign that those assumptions are wrong could hit the valuation hard. Hashtag tag outro.
Wow. Okay, this has been an incredibly detailed look under the hood at Fabrinet. We started off asking, how did this specialized manufacturer, primarily in Thailand, become such a critical, high-value player in the whole AI infrastructure boom?
And I think the synthesis is pretty clear now. Fabrinet is this high-precision specialist, right? They leverage that deep engineering DNA, maybe tracing back to Seagate, and combined it with this unique, conflict-free business model to make themselves indispensable.
They got deeply embedded.
Deeply embedded in the most critical product roadmaps of the tech leaders, NVIDIA, Cisco, AWS. The whole investment case really hinges on betting that this AI infrastructure spending spree has legs, that it's durable.
And the challenge for the company is walking that tightrope, managing explosive growth, while navigating those really acute risks, like the customer concentration, and dealing with the short-term bumps like supply constraints and margin pressure during this big expansion.
Exactly. And as you, the listener, continue to watch this company, there's maybe one key indicator to focus on. It kind of links their operational progress directly to their future financial strategy. It might be the most definitive signal to watch going forward.
Okay, what is it?
It might not actually be next quarter's revenue number or even the EPS guidance. The most crucial factor to track could be the timeline for completing Building 10.
That $132.5 million expansion.
And, crucially, the subsequent normalization of their capital expenditures. When does that heavy spending cycle end?
Right, because when that big expansion is done, the CapEx numbers should drop significantly.
Right.
And their free cash flow conversion should jump dramatically, causing that already huge $934 million cash pile to start swelling even faster.
That's the pivot point. So the provocative thought to leave you with is this. What move does management make then? When that war chest is overflowing and they're generating significantly more free cash flow quarter after quarter.
What are the options?
Do they finally pull the trigger on a large strategic acquisition? Maybe buy something in a complementary field like advanced material science or a different type of sensing technology to broaden their capabilities? Or do they stick to their organic knitting and announce a massive increase in their share buyback program? Maybe a multi-billion-dollar authorization to return that excess cash directly to shareholders.
And what would that decision tell us?
Well, What does that choice signal about management's own view of the long-term growth ceiling for this AI component market? If they go for M&A, maybe they feel they need external tech or scale to keep growing rapidly. If they just ramp up buybacks significantly, perhaps they believe the best opportunities are still internal, capturing more of the current market, and they're simply returning cash while waiting for the next big internal expansion cycle.
So, acquisition versus buyback. As a signal of confidence in future organic growth versus needing external help.
It could be the ultimate tell about how long and how high they think this AI investment cycle can run.
A fascinating question, tying technology, finance, and strategy all together. Definitely something to watch. Thank you for diving deep with us today.
My pleasure.
We'll catch you on the next deep dive.